Every ETF has a job. Every job has a purpose. I want you to remember that sentence because it completely changed the way I invest. Every week I get questions like, Ken, which ETF is better? SCHD or CHPY? QQQI or QQQ? SPYI or SCHG? And every time my answer surprises people. You're asking the wrong question. Because after spending years researching ETFs, building my own retirement portfolio, and testing hundreds of different scenarios, I realized something that completely changed how I look at investing. Great retirement portfolios aren't built by finding the perfect ETF. They're built by hiring the right ETFs for the right jobs. And once you see your portfolio this way, I don't think you'll ever compare ETFs the same way again. So stay tuned. Welcome back to Simply Money. Think about the best organization in the world, championship sports teams, successful businesses, even families. What do they all have in common? Not everyone does the same thing. The quarterback doesn't block. The offensive line doesn't throw touchdowns. The CEO doesn't do payroll. The accountant doesn't run marketing. Everyone has a different responsibility, but they're all working toward the same goal. Now think about investing. Somehow, we expect one ETF to do everything. We want it to grow like a technology fund, pay income like a covered call ETF, protect us during market crashes, beat the S&P 500, and somehow never go down. If I described a person like that, you'd tell me I'm asking for a superhero. Yes, that's exactly what many investors expect from a single ETF. The problem isn't the ETF, it's the question we're asking. For years, I asked the same question most investors ask. What's the best ETF? Every time a new fund launched, I'd compare it. Every time yields changed, I'd compare it. Until one day, I realized something. That isn't the question. The better question is, what job am I trying to fill? Because once you know the job, everything changes. You're no longer looking for the best ETF. You're looking for the best candidate for a specific role. That's a completely different mindset, and it's the foundation of everything you'll see on this channel. Let's look at one of the questions I get more than almost any other. We'll look at a real example. SCHD versus CHPY. Which one should I buy? Well, before we answer, let's step back. Imagine you're hiring someone for your business. One candidate is an incredible long-term strategist. The other is exceptional at generating immediate revenue. Which one do you hire? Well, it depends on the job. That's exactly what's happening here. SCHD's job isn't to generate the biggest paycheck today. Its job is to grow my retirement income over decades. It focuses on quality companies with a history of growing their dividends. Now look at CHPY. CHPY isn't trying to become SCHD. Its mission is different. Its job is to generate meaningful cash flow today. Those are two completely different responsibilities. So which one is better? Neither, or maybe both, because they aren't competitors. They're teammates. And that's the moment I stopped building a collection of ETFs and started building a retirement team. Now let's validate this with data, because if you've watched this channel for any length of time, you know I don't want you to just take my word for it. Let's open up the portfolio planner. We'll compare 3 portfolios, 100% SCHD versus 100% CHPY versus a combination of both. Then we'll look at the results, the growth, the income, portfolio value, income over time, and we'll see some differences here that I want to point out. For those that are new to the channel, this is the Simply Money Portfolio Planner. This and all of our tools are available down below in the description at Buy Me a Coffee. If you'd like a copy of that, it is available there. I appreciate all the support of those who have bought that, and I hope you're enjoying these tools. I created these tools because I wanted to be able to replicate the process I use, and the entire Simply Money channel is focused on replicating what I do, whether it's with the funds I have or other funds, and I'm trying to make it to where you can use the same philosophies and the same processes, not necessarily have the same funds, not necessarily have the same team, because we all have different goals. And remember, personal finances are personal, and this is not financial advice. This is for informational and educational purposes only. know that all investments come with risk, including the risk of losing capital. What we're going to look at here is we have the 2 tickers. This sheet, you can put up to 10 tickers in here, and you can put different allocations, and you can compare conservative, moderate, or aggressive. What I'm using it for today is I'm just simply comparing SCHD. We're going to put 100% in the conservative, CHPY 100% in the moderate, and then the aggressive, we're going to go 50-50. Obviously, that's not their label, conservative, moderate, or aggressive, but this will make it very easy to do some quick comparisons. With this scenario, we're just going to do $100,000 as a guide. It could be $10,000 and you're building it. We could do $1 million and you're living on it. I am doing $100,000, not accumulating anything. We're taking the income immediately just to show you the differences here. We have the return mode set on the 50th percentile, which is going to give the average expected return in the future based on the type of fund it is. And so we're going to look at that. So let's jump over here. You just go to the forecast. Because we don't have any deposit or withdrawal rules set, we're just coming to forecast. And up here, the model, we want to look at SCHD first, so that is in the conservative. You can see our $100,000. I want you to see a couple things and leave comments down below. What do you think on this? As I'm doing this, leave your comments. When you begin with SCHD, you look and say, wow, only $250 a month. That is crazy off $100,000. I want you to watch this. We're going to go to the end of 10 years, and right here you see that the balance is up to $235,000, and your income is tripled. Again, it's not just out of this world crazy returns. It's just a nice, slow and steady build your income. Why? Because that's the job I hired it to do. This isn't I need tons of income. This isn't I need it to grow maximum amount. This is my fund that is on the team to build my future income consistently and steadily. And it's doing its job. If you've watched my videos, you can check it out on the channel, my SCHD holdings and how they've grown over the last 9 years and how my income and my yield on cost has grown. It is doing its job. That's how I hire ETFs. I don't just get an ETF because it looks good or the yield's high or the return's amazing. I find the job I'm trying to fill. Where's my portfolio needing something? What job is that? And what ETF will fill that job the best? That's how I approach it. Now I want to switch it over here. You can see $250 a month with SCHD. Now you're going to be amazed. CHPY, watch this. And this is right here. People are like, CHPY's better. I'm going to get CHPY. But CHPY's job is I need income now. It's replacing my paycheck. It's my retirement paycheck. Yes, it is producing what I need it to right now, but is it going to do what SCHD does? No. Watch. As we come down to year 11, what is happening here is we see now it's down to $772 and our ending balance is only $35,000. Now this is on the 50th percentile return. Where people make the mistake is they'll just go to the historical. I'll go back over here just so you can see that. If we flip this to historical, this is what it has done since inception. This is its average annual return, and this has only been around for a year or so. You don't have a lot of data to go by. This is not a healthy way to project the future. It's great to see how has it done, but it has been an extreme bullish market. That's not going to continue for 5, 10, 20 years. But watch what happens, and this is where people go crazy. They're like, oh, look at that, $4,300. You're not doing this right. Look at that, $162 ending balance. Because I don't expect that CHPY is going to sustain a 25% yield with a 5% appreciation for any length of time. Short periods, yes, but I'm looking at long term because I plan on retiring and living more than 5 years. I'm not sure about you, but I have goals of retiring and living and providing for my family more than 5 years. I'm going with the 50th percentile, the average expected returns, and that's what you can see. And that's where this team, the Income Now team, may have to make adjustments. You may have to switch players out, hire somebody new. They start out sometimes great. Something else I want you to see. Now let's look if we do a combination. And again, I don't have a 50-50 balance on my portfolio, but just here to give you an example, you can see if you balance them, starts out about middle of the road. If you come down to the end of 10 years, you can see you've actually still grown your portfolio, not as quickly, but when you balance them, when you have a team working together, that's how you can get that growth and some immediate income. It's not one or the other. It's not everything goes into one team. And I wanted you to see that because that's really important. Now, I want to look at a couple other scenarios just to give you some examples. And that's if we get an average market over the next 20 years. We did 10 years here. You can see that over 10 years, things typically average out. But let's just say, and this is where a balanced team, everybody doing their job, can come in handy. Let's say we have a really bad market. We have a 10th percentile market, what we'd call a lost decade, where the next decade doesn't really have any strong returns. What would happen? And this is where balancing helps out, because some funds are meant to help hedge against that thing. And then in an aggressive market, maybe we get a 90 percentile market, a huge decade of bull market, you can go ahead and see that while other funds, this would take off. So you have the balance where SCHD may not take off in a bull market, but it may not drop drastically in a bear market. And that's where we want to look. So you can see, obviously, you're getting less income. As we come down to the 10-year mark, it's still growing. Again, at a slower pace, but it's still growing. It's still doing its job, even in a horrible market. It's doing what it's designed to, moving your income forward. Let's look at what happens to CHPY in a bad market. Starts out about half of where it would be in a 50th percentile market. And again, at the end of 10 years, look at that. You're almost exhausted your entire account. See, its job's not to grow your income long term. And that's where you'd have to watch it. Maybe it's time to switch players. And again, if we went to the aggressive where we have it split 50-50, you can see that it still loses some of that because CHPY is pulling it down so hard. And that's where I don't have a 50-50 balance between something like SCHD and CHPY. My income growth versus my income replacement teams have different jobs and different allocations. You can check out the video from the other day that shows that exact thing. That is what we're looking at here. And I want that to be something that really sticks in your mind. And I want you to see there isn't a winner. There are trade-offs. Different portfolios produce different outcomes because they're trying to accomplish different goals. And that's exactly what we should expect. Now let's take it one step further. When I'm making a decision, what fund do I want to get into for my income positions? I use the Simply Money drip score. This again is a replication of what I do. And I apologize for all the NAs right now, because as I am recording, it is 4 o'clock, the market's closing. So all the data is trying to update and it's waiting for the markets to close. That happens. If you ever see that, don't panic. Hit the refresh button up here and it'll refresh momentarily. But my point is showing you this is that with these different tickers on the drip score, you can see, has this done well? Has it grown? Is it a good fund to drip into because it's doing better by dripping than taking cash? Or is it better to take the cash? Is it currently a good opportunity to invest in and put the drip back into? There's a lot of information on this. Again, I have a lot of videos. I'll be going over this again as we continue to go through the process of how I pick ETFs that hire for my team when I am looking for it. So when I'm looking at my high income, I need a player on my team, my income replacement team, someone that's going to be part of my retirement pay team. I am looking right here and I'm doing research, and this is the first tool I use. I'm not using the drip score to compare SCHD against CHPY. Why? Because they don't have the same job. Instead, I use the drip score to compare against other income producing ETFs. Now, yes, SCHD is on there, and there's some other income growth ETFs on there, so you can compare those together. So you have to know what it is you're comparing and why it's important. Because once I've identified the job, now I want to hire the best candidate for the position. That one distinction changed everything about how I research investments. Now, this is probably the biggest investment mistake I see. People compare ETFs that were never designed to accomplish the same objective. Instead, compare ETFs that are applying for the same job. Compare growth funds against growth funds, dividend growth against dividend growth, and income funds against income funds. Then build a portfolio where every investment complements the others instead of trying to replace them. And that's how teams succeed. and how portfolios succeed. I want you to be looking forward. In a couple weeks, we're going to have a video coming out that shows what kind of resources should I put into each team, depending on your age, risk tolerance, different factors. If you're 30 or 60, if you're needing the income now or in 10 years, how much of the allocation of the resources should I put into each of those teams? And I'll outline that for you here in a couple weeks as we continue moving through outlining the Simply Money principles of investing and picking the right ETFs for the right job. Now, I want to look at why this changed my investing, because once I understood all of this, everything else started falling into place. It changed how I research ETFs. It changed how I compare investments. It changed how I build portfolios. It even changed how I think about retirement. Eventually, I realized I needed a repeatable system, not opinions, not guesses, a process. That's what led me to create the 4 Simply Money frameworks. We have the drip score, the portfolio planner, the retirement stress test, and the portfolio manager. I want to show those to you real quick for those who have not seen those. We've seen the drip score just a moment ago. This is what helps me pick income positions. Now, this isn't going to help me with my growth team. This isn't going to necessarily help me with every team, but for my income and my dividend growth income, I can use this and it can help me pick team players. The other thing I use is what we were just going over, the portfolio planner. This is where I can compare teams or compare different players against one another, and I can put those in. I can do different allocations, maybe one team and the other team. Maybe I have the full team listed here, and I go ahead and do different allocations to see how much resources do I want to put into each of those teams. Once I've figured out my team and I have my yields and my appreciation averages and what my outcome could be, I can plug that in here to the Simply Money retirement stress test. This is where I can put what would my starting balance be, say, in 10 years when I'm looking to retire. What is my income need? And you can put all this different information in. It runs a Monte Carlo style simulation, and you can go ahead and test and stress test. It even gives you a stress test confidence score. When you run it, it shows you you're excellent or 100% confident, and it shows you a lot of different information here. Again, I have some videos on the channel you can look at on those. This is just to show you the process I use and why I've created this. The final one I have is a Simply Money portfolio manager, because once we have all of those decisions made, we want to track our portfolio. We want to keep track. Is it doing what we said we wanted it to do? You can set it up with allocations. You can set your team up based on perhaps where you have it in your accounts. You can mix and match different accounts, and it tracks that. So once you set it up, all you do is put in your transactions. If I made a buy, I did a sell, I withdrew, I took dividends, I reinvested dividends, I redirected dividends. Anything you're doing, you just simply put a quick transaction in here, and it's going to track based on what you set up and what you've done in transactions from then on. And it shows you your portfolio with key metrics there. There's an income report, there's a health check, and there's the history, so you know the last time it ran. And we'll be building this further down the road, version 2, whereas you have month over month, it'll begin to show you yield on cost, income growth, or depreciation. Are you gaining income or losing income? And it'll track even more. But we have this set up now where it's tracking based on what you put in from your portfolio builder. Those are the 4 frameworks for Simply Money that we use. And don't worry, we're going to dive into each of these throughout this series and ongoing throughout the channel as we're deciding what ETF fits the job you're looking for. But they all started with this one simple idea. Every ETF has a job. From this point forward, every ETF review, every portfolio update, every comparison, every retirement model will start with one question. What job is this ETF trying to perform? Everything else becomes easier. Next time, we're going to take this idea one step further by looking at how to decide which jobs your own retirement portfolio actually needs before you ever buy another ETF. Until then, stop looking for the perfect ETF. Start building the perfect team, because remember, every ETF has a job. Every job has a purpose. That's it for today. We'll see you next time on Simply Money.